Okay, you guys ready? All right, we're rolling. Quiet on the set. Clap, action. Yeah. No, that clap is later. All right, lead us off. Go for it.
Hello and a very good afternoon to everybody present here. We are Team Gate, and the company we have chosen to present today is Nike. Today we'll be talking about Nike's industry, financial, and ratio analysis, along with a conclusion based on our research. Just a brief introduction on Nike. Nike is an American multinational corporation founded in 1964. Its headquarters are located in Beaverton, Oregon. It is engaged in designing, marketing, and selling of footwear, apparel, accessories, and equipment. Nike is the world's leading supplier in athletic footwear and apparel. Its worldwide brand value is estimated at $32.4 billion US dollars, and its current market share is about 27% as of 2019. A few of Nike's rivals include brands such as Under Armour, Puma, and Adidas. Now Tina will continue with the industry analysis.
So the way that we analyzed Nike's industry was by using the SWOT analysis and Porter's 5 Forces. The strength that Nike has is that they have a diverse brand portfolio. They not only sell athletic footwear, but apparel and accessories and sports equipment too. One weakness that Nike has is that it is currently in a lot of debt. The amount comes to $3.49 billion. However, their income statement is in good condition and it is profitable. An opportunity that Nike has is that it has emerging markets. They have plenty of market opportunities to exploit worldwide, such as in India, Brazil, and in China. A threat that Nike faces is that they are prone to the fluctuation of the foreign exchange rates due to its global operations. The money is reported in US dollars, and this affects the revenue because the currency is exposed to the variability of other financial crises. Now looking at Porter's 5 Forces, we see that the level of industry rivalry is high. Nike has been fighting its competitors such as Under Armour and Adidas by investing a lot of money in marketing. The bargaining power to buyers is moderate. This comes from Nike continuously offering their clients the best quality. The bargaining power to suppliers is low because Nike can switch to other suppliers as when they do not adhere to Nike standards. And they have a total of 620 factories in 42 different countries. The threat of substitute products is moderate, and this is because Nike is always producing such a unique design and the quality is a bit hard to replicate. The threat of new entrants is low because it is quite impossible to replicate and create the kind of brand awareness and image that Nike has created overnight. It took Nike years of trial and error to achieve what they have today. And so Valentin is going to be talking about the financial analysis.
Yeah, thank you. So in order to get a true picture of the company's financial situation, we conducted a horizontal and vertical analysis of Nike and Under Armour. We chose the time span from 2015 to 2018 for both companies because the fiscal year of 2019 has been ending so far for Under Armour, so I'd just like to make it more comparable. So if we take a look at the bar chart on the left-hand side, it shows the Nike income statement, and it is clearly evident that there has been a steady overall increase across almost all positions in the income statement. And this leads to a revenue plus of over 22% from 2015 to 2018. Also, this could be considered as really remarkable as Nike is a huge company, so it's a big plus. And also how healthy the company is operating is clearly evident in its increase of the net income over the years. In 2017 it has been 12.34%, and in the latest year we analyzed in 2018 there has been still a positive number of 5.31%. The small downward trend at the end might be due to a huge governmental tax increase, which we'll address later on in more detail. On the other hand, on the right-hand side, we see the income statement of Under Armour, and we can see that there's also been a huge increase of the revenue over the past past years, almost beating it by 3 times in comparison to Nike. And we have to address this trend really carefully because the company size is very different. So smaller enterprises can facilitate growth way easier than big ones. And also there has been a negative trend in the net income over the years, ending up to a small but still negative number of 0.89% of the net income. At this point, I would like to skip the analysis of the balance sheet because no remarkable trend has been found there. Overall, it can be said that the total assets increased for both companies. For Nike, it has been 20%, and for Under Armour, 74%. And so let's take a closer look at the liabilities. The bar chart shows again that there has been an increase of the total liabilities over the past 4 years for both companies. Again, it has been 24% for Nike, and Under Armour is outnumbering it again by 111%. A notable trend here is that the total liabilities consist almost by 100% of current liabilities, and this trend is evident for both companies. On the right-hand side, we took a closer look at the long-term notes payable because we found an interesting movement from 2016 to 2017. So first, the long-term notes payable decreased and then rocketed up again over 32,400% in 2017. And referring to the 10K report of Nike, this increase is being due to massive purchases of Nike branding products from non-US sellers. Now I want to hand over to Jadon, who is addressing the ratios.
Now let's look at the comparison financial ratio between Nike and Under Armour to have a better sense on how Nike did on the athletic apparel industry. Now if you look at the first ratio, which is the ROA, you can see that Nike is doing much better compared to Under Armour. They are able to utilize its resources well in generating income. Although on 2018, which is right over here, you can see that they have a dip from 0.19 to 0.09, and that is due to a loss to a one-time tax on foreign earnings from the Trump administration Tax Cut and Jobs Act. For the rest of the ratio that I'm going to talk about later, Nike's ratio in 2018 always have a dip on 2018, and that is all due to the Tax Cut Act. But as you can see, they always recover on the 2019s. The next ratio that I'm going to talk about is return on equity. Based on the ratio, Nike is able to increase its ability to generate profit without needing as much capital. The third ratio, which is the profit margin, Nike was able to manage its expenses relative to its net sales better than Under Armour. And the next ratio is the current ratio. Nike has a much healthier current ratio compared to Under Armour. Since their current asset is more than their current liabilities, they are in a desirable situation because they have more than enough cash to pay for their short-term obligation. The next one is the quick ratio. And based on the ratio in the table, we can see that Nike has enough quick asset to pay for its current liabilities. And the next one is the debt to equity ratio. Nike has a significant lower number compared to Under Armour, and this means that Nike is a more financially stable business compared to Under Armour. And the next ratio is time interest earned. As you can see from the table, Nike has a really high number on all of the 5 years, and it also shows a gradual increase from 2015 to 2019. Based on the 2019 ratio, it shows Nike makes enough income to pay for its total expenses 97 times over. The next ratio is the asset turnover ratio. Having a ratio of 1.62 on 2018 means that each dollar of assets, Nike generate $1.62 worth of revenue. But Under Armour's ratio is 2.61. That means that Under Armour actually is doing much better at using asset to generate sales. The final ratio is the inventory turnover ratio. Nike has a relatively high turnover ratio compared to Under Armour, and it gradually increased each year. on year 2018, it shows that Nike has a ratio of 7.25 compared to Under Armour at 2.93. And Nike has more than 2 times the amount compared to Under Armour. It shows Nike are more efficient in managing their inventory. As a result of the analysis of the key financial ratio of the company, we have established the following. The financial condition of Nike is much better than the financial condition of Under Armour, and this conclusion is supported by the result of a comparison of both the company's financial ratio. Now I'm going to pass it on to Grace to talk about stock price as well as if you should buy, sell, or hold both of the stocks.
So now we're going to have a closer look on the stock prices. As most of people know, Nike is a highly predictive brand. The actual market value is over $40 billion. The current PE ratio is 33.49, which represents recurrence and stable growth. So it's good for the investors. The current price of Nike is over $89, which is a really good price. On the charts, you can see that here the lower price for the last 52 weeks was $66, and here it was $96. So now, what to do? We recommend to buy Nike stocks. Why? Because Nike is reliable, it generates a lot of money, and as you can see, the average earning per share for the next year is over $100 based on their current prices of 89, which represent an increase of more than 28%, which correlates to with the current PE ratio and represents a stable growth. So now, if you want to focus on competitor and if you want to know which is really valuable, we can look at Under Armour. The average earning per share for the following year of Under Armour is $34 based on their current price of $17, which represents a huge increase of 93%. So it shows that both of them can be profitable. The most profitable is definitely Nike and more secure investments. Nike has a return on investment of 47% compared to 5% regarding Under Armour. So if you want to invest in a secure company and have a higher return, you can invest in Nike. And if you want just to experience a booming market of altitude that Under Market is on, you can invest in Under Armour, but it's going to be more on a long-term investment. So yeah, thank you.
Thank you.
So, just a quick question. The ROA, you're saying that ROA went down because of the tax cut?
Yes.
But the tax cut lowered the taxes, which normally you think would make the return or net income go up, right? So why would a tax cut make the tax expense go up?
Actually, it's because on that 1 year, on 2018, I think, actually they increased, I think, the tax rate for the foreign earnings.
Oh, okay.
Yeah, for the foreign earnings, if I'm not wrong.
So it was not the
Oh,
U.S.
it's a loss to a one-time tax on foreign earnings from the tax cut act.
Okay.
Yeah.
All right.
Sorry, Shi.
Oh, I got it. Yeah, so it was not the tax cut per se, it
Yes.
was the effect on the international
foreign earnings,
taxes.
yes.
Okay, good. So thank you. You guys ran a little over. Notice I didn't cut them off at 10 minutes. So I kind of allotted to 10 plus 2. So I don't really want to cut them off. They've done the work. I want to see it. Some props would just kind of ring the bell and cut you off, but I want to hear it out. So I'll let you guys run the 12 minutes. So we're not going to have many questions. Okay? But thank you.